Good morning, guys. Okay, so a bit to unwrap. Let's go and have a look at the calendar and go through what happened. The BOJ, wow, a bit of a nothing, really. The market was weakening ahead of their announcement. As here you can see, the yen was weakening ahead of it, but after the announcement, when they realised nothing was happening, market came off and was led around by the US dollar. Next thing was the pound, which interestingly is off a little, but it's still 10.5%, over 10% inflation, and the pound decides to get bullish. Where was the announcement? Was at 5 o'clock. So here was the announcement, and the pound got bullish until the US dollar dominance started to come in. And the US dollar dominance, right? So bad news is good news. We saw retail sales tank, productivity or manufacturing inflation also weaker. Retail sales, again, it's core retail sales and retail sales month to month. So not a good, pretty picture. So not a soft landing that everybody's looking for. And so surprisingly, bonds came off on that. Unsurprisingly, stocks weakened, got smashed, and about time too. VIX is up a little bit, as we can see here. VIX, as that protection starts to come in, and if we look at it in sort of global picture, we can see the US dollar getting that safe haven bid, right? So as stocks weakened nicely off that trend line, we're getting that safe haven flow back into the US dollar. Even though the US bonds were off, we're seeing that safe haven flow into US dollar, and therefore dollar strength saw gold weaken and all the majors weaken, and certainly stocks also weaken. And oil was the other one I wanted to look at. Also got punished thanks to a stronger US dollar. All the commodities were off a little weaker, sort of indicating that they're not going to get a soft landing. Right? So interest rates are going to be higher for longer, and as I mentioned earlier in the week, we're going to see a lot of Fed heads talking about that, and they all did. There was about 5 or 6 of them came out overnight, all saying that rates are going to be higher and where they are now, and they're going to remain higher for a long time. And so a couple of charts I want to show you is that this is one of them. This is what the market's implying, is that interest rates will go up a little bit more, but will then by June they will start to be coming down in sort of July, and market's already pricing in by the end of this year that interest rates will be back down at sort of 4%. So don't know if that's going to happen. I think they've got it wrong. Another chart that I wanted to show you is this is the difference between the 3-month treasury note and the 10-year bond, what they call the spread between it. And you can see here, these are the last times we had a recession, right? So every time it goes under the or into what they call contango market, where the yield curve is negative, you get a recession not long after. And we haven't been this low, not since probably the 80s, I would say, which is indicative that once it does bottom and you see that yield curve starting to turn back up again, we're not far away from a recession. So to me, we're going to be having that recession this year, later this year, and interest rates will remain high until that inflation comes down. So it'll be sort of a couple months into the recession before we start to see interest rates turn and come down, and to me that's probably this time next year. These things don't take weeks, it take months for that to filter through. So with that in mind, as we're leading into the recession, you're going to see stocks weaken and continue to weaken, and the US dollar should continue to strengthen. It has been in a bit of a downtrend. I didn't want to do that. I wanted to come here and go to US dollar, dollar index. It has been in a bit of a downtrend for the last couple of months, but I would look for, and it has sort of held off this support line here, this previous low, bounced off that nicely. I think I spoke about that earlier this week. I would be looking for the US dollar to sort of track this way as a safe haven bid, as people look for the government bonds, the US Treasury, as a place to park their funds when stock markets sink. Because gold is a good safe haven, but it doesn't pay you any interest, whereas the bonds are clearly paying you something right now. 3.37% yield on the bonds at the moment. So whilst they are off today, I would expect those the bonds to be going up, not coming off. All right. On that note, I shall see you tomorrow. Thanks, guys.